I want to welcome everyone to SCORE Central Jersey, our chapter's webinar on how to secure a bank loan from a banker's perspective. So I hope everybody is in the right place this morning. I believe most everybody is familiar with SCORE. If you're not, just a quick advertisement for SCORE. We hope you come join us and look for a mentor. SCORE is a nationwide organization. We're a resource partner with the Small Business Administration. And our mission is to help small businesses either get started or if you're already in business, to help you grow and prosper. We have lots of chapters across the country. We have over 10,000 mentors around the country. So no matter what topic, what kinds of information you're looking for, we should have someone that could be able to help you. Our services are mostly for free. Some of the chapters do charge a very small fee for webinars. Our chapter doesn't. But our offerings primarily are seminars and webinars. The most important thing we do is mentoring. One or two small business experts can meet with you and talk about whatever issues you're having if you're starting or growing or even expanding your business. Go to our website, look, there's a space where it says find a mentor. Find a mentor, we'll be in touch with you, and we would love to work with you. So today we're really excited to have one of our own specialists. Hassan Pride is an active member of centraljersey.score, and he is a banker. He's going to talk to us about bank loans. Hassan is Vice President of Commercial Banking for Investors Bank, and his contact information is on the slide, and I think he probably has it on his slides as well. So without further ado, Hassan, you want to take it away?
I've been in banking for a little over 20 years, where I've spent most of my career in commercial lending. My commercial lending experience ranges from underwriting small business loans through the SBA program to underwriting participations in syndicated transactions in the hundreds of millions of dollars and everything in between. Currently, I'm a senior portfolio manager with Investors Bank, where I underwrite loans for what we refer to as lower middle market companies. And these are companies with revenues primarily in the $10 million to $30 million range. Okay. My goal today is to provide you as small business owners and entrepreneurs with an understanding of what bankers are looking for when considering your commercial loan request. By the end of this presentation, you should be familiar with the most common loan products and their typical uses. You should also be familiar with the initial financial documentation that just about every applicant needs to provide to a bank when seeking a commercial loan. Another takeaway should be an understanding of the key questions bankers attempt to answer when considering a loan request. Now, before I begin, I have a disclaimer. Banks come in a variety of sizes and have a variety of resources available to them. When I last checked, there were 116 different banks and credit unions that do business in New Jersey. And I'm not talking about 116 different branches. I'm talking about 116 separate financial institutions that have a presence in New Jersey. Among these are institutions where a $600,000 loan is a significant loan amount and requires approval from the top of the house. And then there's institutions where spending time on a loan request under $1 million is considered a waste of time. Now, I say this to point out that it is virtually impossible to have complete uniformity among these institutions in their lending processes and decision-making. So the ideas that I present to you today are general in nature. For instance, I suspect that there are some entrepreneurs on this webinar that are probably seeking relatively small amounts, which can be approved at some institutions based solely on credit scoring methodology. If those borrowers have good business credit scores from one of the three major business credit bureaus, such as Dun & Bradstreet, Experian, or Equifax, they may find a bank that can approve their loan with minimal due diligence required. But what we're discussing today reflects how a typical loan is underwritten by an underwriter at a commercial bank. In other words, when it's underwritten by an actual person, not just approved by credit scoring. Okay. So let's first begin by discussing a few of the most common types of loans small business owners seek from a bank: term loans, commercial mortgages, and lines of credit. To be sure, there are several other subcategories, but in today's webinar, we're just covering the fundamentals. For instance, we'll discuss a typical term loan structure that small business owners obtain, but we'll not cover more sophisticated facilities like delayed draw term loans or distinguish differences between term A loans and term B loans. The idea is just to give you the general attributes so that as you approach a bank for a loan, you have an idea of the type of loan that is going to meet your needs. So let's discuss term loans. A term loan is one of the most fundamental credit facilities. If you've ever taken out a loan to purchase a car and had to make monthly payments on that loan, then you're familiar with the term loan. A term loan is a loan from a bank for a specific amount that has a specified repayment schedule. Business owners typically use term loans to purchase assets like computers or equipment, or to consolidate and refinance existing debt. Term loans can be short-term, say a couple of years, or long-term. For instance, commercial mortgages can have terms of up to 10 or 15 years. So here are some things to keep in mind when considering a term loan from a bank. One, if you're using the loan to purchase a business asset, the bank is usually going to use that business asset that you're purchasing or refinancing as the collateral for that loan. For instance, if you're a manufacturer and you're purchasing the latest extruding machine, then that extruding machine is going to serve as the collateral for your loan. But let's say that in the past you used credit cards to purchase your equipment, and now you're looking to refinance that high interest credit card debt with a term loan. Then the bank may take a lien on all of your business assets. That process entails the bank filing what is known as a UCC lien on all of your company's assets. Now, in general, this will exclude real estate. So in the first instance, because you are buying a specific piece of equipment, you can have an arrangement where the lien is only on that single piece of equipment that you're purchasing. But in the second instance, the bank is going to place a blanket lien on all business assets of your company, not just a specific piece of equipment. The other thing to consider about a term loan is, in fact, the term of the loan. In other words, how long of a maturity that loan will have. It is typical that if the loan proceeds are used to finance the purchase of an asset, the term of the loan will not be greater than the useful life of that asset. So in the case of an extruding machine, if we imagine that the useful life of an extruding machine is, say, 10 years, and I'm just making that up, then a bank will not provide a term loan to purchase that machine for longer than 10 years. And the likelihood is more along the lines of a 7 or 8 year term. Another component to consider in a term loan is the interest rate. Now, most people think that the interest rate on a term loan is always fixed and your monthly payments on that loan will remain the same throughout the term of the loan. While fixed rate term loans are the most widely offered term loan products, just be aware that this is not always the case, as the interest rate on a term loan can also be variable, meaning that the interest rate and therefore your periodic payment amount can fluctuate depending on the index that that rate is tied to. Okay, now let's talk about commercial mortgages, which is another common type of loan that business owners usually seek to secure. Essentially, a commercial mortgage is a term loan, but specifically, it is a term loan secured by a mortgage on commercial real estate. So the typical uses for a commercial mortgage are to purchase commercial real estate, to refinance debt, or in the case where the business owner already owns the real estate free and clear, they can take cash equity out and use that cash for expansion or some other projects. Now let's discuss some of the characteristics of a commercial mortgage that differentiates it from just a typical term loan. First, as we mentioned, the loan is secured by filing a mortgage on real estate. Recall that the run-of-the-mill term loan is secured by filing a lien on business assets other than real estate. Secondly, even though a commercial mortgage can have a term of 5 or 10 years, because the useful life of commercial real estate is longer, the amortization is longer than a typical term loan. So what is amortization and how does this relate to the term or maturity of the loan? Think of amortization as the length of time that it will take to pay the loan down to zero. If we think of a 30-year mortgage on a house, if you make 360 consecutive payments on your mortgage on time, at the end of 30 years, you will have repaid that loan off. But because the amortization, and this is because the amortization is the same as the term, but banks, however, do not provide commercial mortgages with significant maturities like 25 or 30 years. It is common to receive a commercial mortgage for 5 or 10 years with a 25-year amortization. This means that the payments will be calculated as if the loan will be paid down to zero at the end of 25 years. However, the loan will mature at the end of 5 or 10 years so that there will be what we refer to as a balloon payment at the end of the mortgage. So what happens at the end of the mortgage when that 5 or 10-year period matures? The borrower will just refinance the balance with some other commercial mortgage. The other thing that borrowers should be prepared for are the higher costs that are associated with commercial mortgages relative to obtaining a typical term loan. The borrower should be prepared to pay an appraisal fee for an appraiser that the bank will order to verify the value of the property. Now, this will be in addition to an appraiser that the borrower may have gotten on their own. A typical expense that, another typical expense that borrowers should consider are phase 1 environmental reports. Now, this will be ordered by the bank if the potential exists that there may be contamination on the site. So if you're purchasing a building on the former site of a gas station or even adjacent to a gas station, it is likely that the bank is going to order a phase 1 report on your property. Also, as is the case with other commercial loans, in addition to the borrower paying for his or her own attorney to review the closing documents associated with that loan, the borrower may also be responsible for paying the bank's legal costs to provide that loan. So as you're speaking to a lender regarding your loan, you want to find out what expenses you should expect in connection with your loan. Okay, next we'll discuss lines of credits and some of the uses. A line of credit is a loan facility that a bank provides to a borrower that gives the borrower access to a maximum level of cash within a stated time period. Now, the term line of credit is a pretty broad term because there are so many variations to what a structure of a line of credit could look like. For instance, a line of credit could refer to a working capital line of credit. A working capital line of credit is a line of credit that a business uses to cover the operating costs. Most borrowers tend to think of working capital lines when they're considering a line of credit from a bank because the structure is similar to a credit card, as the funds from a working capital line of credit need only be advanced when the business owner needs the funds. Typically, a line of credit is made available for between 1 to 3 years. So if the business owner can borrow from and repay the loan as long as the line of credit is available and as long as they're in compliance with the loan agreement. So for example, if a borrower gets a $500,000 one-year line of credit from a bank, the borrower can close the loan on day one, but does not have to advance any of that funds until they need it. And they have access to that line of credit for the entire year. Now, if the borrower advances any of that $500,000, they only owe interest on the amount that was advanced, as they pay the principal payment back, the principal amount goes once again back into the pool and it becomes available for that borrower to reborrow over the term of the loan. Now, the idea of a working capital line of credit is to provide the borrower with liquidity at times when their operations don't generate sufficient cash to support all of the company's expenses. An example of a typical use occurs when your business sells to other businesses, otherwise known as B2B transactions, and your business customers are not required to pay for, say, 30 or 60 days. Well, you may pay your employees every 2 weeks, so you cannot afford to wait until you get the cash from your customers in 60 days. So you borrow from your line of credit to pay your employees, and when you get the cash from your customers, you repay the principal back on the line of credit, and it becomes available for you for the next time you need it. Another common use for lines of credits is to support other financial tools like surety bonds or letters of credit. Suppose, for instance, that you're a contractor who bids on municipal projects. Well, many municipal projects require that the general contractor be bonded by an insurance company to ensure that the project is completed. So in order for you to get a surety bond from an insurance company, that insurance company is going to determine the bond size based upon how liquid your company is. So if you have an unused line of credit from a bank, that potentially increases the size of the bond that you can get, which in turn increases the size of the projects that you can bid on. Similar to credit cards, a line of credit can be unsecured, or similar to term loans, lines of credits can be secured by collateral. If it's a secured line of credit, it will typically be secured by liens on the company's business assets, with the exception of real estate. In fact, there are working capital lines of credit known as asset-based loans that are tied to particular working capital assets like accounts receivable and inventory, which leaves other assets like equipment available to be used to secure other loans. While I'm not going to go into the details of asset-based lines of credit today, I do want to talk about another common type of line of credit, an equipment line. An equipment line of credit is a form of a non-revolving line of credit. Equipment lines of credit are designed to assist business owners who have large capital expenditure requirements purchase equipment when they need it for their business. We previously discussed how a term loan allows you to purchase equipment, but with a term loan, the funds are distributed in full on the day that you close the loan. With an equipment line of credit, you can close a loan, but you do not have to advance any money till you actually need the funds to purchase the equipment, which can happen anytime between the day you close on the line of credit until the day that the line matures. For example, let's say that you anticipate needing to purchase a large piece of equipment that costs $100,000 specifically for a project that will occur in October. You can now obtain a 1-year, $500,000 equipment line of credit from your bank, but you do not have to advance on that line right now. Thus, the entire $500,000 is available to you, but you're not accruing any interest because none of the money has been advanced. Instead, you can wait until, say, September to send notice to your bank to disperse $100,000 to pay the invoice for the equipment and have it delivered just in time to start your project. Now you have $100,000 outstanding on your line of credit, and you have $400,000 remaining available, and that can be used to purchase more equipment. So this $100,000 that you have outstanding can be treated one of two ways, depending on the option that your bank offers. For one, the $100,000 advance can immediately become a term loan that becomes payable in monthly interest and principal payments for, say, 5 years, for example. In this case, that $100,000 is treated no differently than if you actually received a $100,000 term loan from your bank in September, which will now be paid in full 5 years from the date you advance it. The drawback to this option is that this form of line of credit creates multiple term loans that you have to keep up with. The other option is that your bank allows you to pay interest only on any advances taken on that equipment line until it matures, at which time the entire outstanding balance turns into a term loan for, say, 3 or 5 or 7 years. Under this method, it creates a single term loan at the end of 1 year. So there we have it, term loans, commercial mortgages, and lines of credit. These are the most common facilities, and they meet the lending needs of most business owners. So next, we're going to discuss information that borrowers typically need when they're requesting a loan from a bank. So a fundamental component of any loan request is the loan package. Generally, when a borrower is looking for a loan, these are going to be the customary documents that are required in a loan package. Now, it's not exhaustive, but the loans here are generally, the items here are generally required in any commercial loan request, regardless of its size. The banker is going to request 3 and at minimum 2 years of the most recent business financial statements, 3 and at minimum 2 years of the most recent years of the personal tax return of each person that owns 20% or more of the business. They're going to ask for a completed personal financial statement for each person that owns 20% or more of the business. Now, similar to the balance sheet and the business financial statement, the personal financial statement lists the individual's assets, liabilities, and net worth. They're going to want to see a copy of a business plan, particularly if the business is new or are looking to grow. They're going to want to see a business debt schedule listing any existing debt on the business. And they're also going to want any other relevant information associated with this request. For instance, if the loan is going to be used to purchase a building that may have tenants in it already, the client is going to need to supply the bank with a copy of a signed purchase agreement for the building, as well as copies of leases for all of the tenants, or at least a rent roll that lists the tenants and all of the pertinent details that you will find in a lease, like the terms and the monthly rent amount. Now, if a client is organized with the proper basic financial information already available, they're viewed more favorably than a client that is sending everything in piecemeal because they didn't know what would be requested. Now, I mentioned before that the lender is going to want to see the business financial statements. Now, I'd imagine that for many business owners listening to this webinar, the financial statements will be in the form of business tax returns. Now, there are more preferable reporting documents prepared by CPAs, such as audited financial statements, reviewed financial statements, and even compiled financial statements. Now, these type of financial statements cost more, but tend to provide more detailed information than tax returns. So given the limited detail provided in tax returns, business owners should be prepared for loan officers to ask for more additional financial information, which would normally be included in these higher quality financial statements. For instance, I mentioned that if applicable, the business owners should provide a listing of existing debt. In some of these higher quality financial reporting statements, that information would already be included in the notes section of the reporting. Now, I mention this because I find that sometimes small business owners feel that banks are being intrusive when they ask for more detail. But this is just a normal course of the way underwriters operate when underwriting business loans. Now, I imagine if this is not your first time attending a seminar on applying for a bank loan, whatever previous seminar you attended probably centered around the 5 C's of credit. Now, this is the typical approach that most bankers take when trying to explain to borrowers what they should think about when considering applying for a business loan. As a refresher, those 5 C's are character, which refers to the trustworthiness of the borrower or the guarantor; capacity, which refers to the borrower's capacity to repay the loan; capital, which considers the cash or equity that the borrower has to inject in the business; collateral, which examines just that, the collateral that will secure the loan; and conditions, which considers the borrower in the context of its industry and the current economic conditions. Now, while this approach is not wrong, I think it's a bit esoteric. Sure, these are the concepts that a banker considers when underwriting a loan, but in what way do they consider these concepts? What type of questions does the banker ask to evaluate these concepts? Well, that's what I'm going to share with you next. So I like to remind clients to think of those question prompts that we all learned in elementary school: who, what, when, where, why, and how. These are the prompts that lenders use to examine a business loan request. So we'll spend the next few minutes taking a look at some of these specific questions that lenders ask themselves and examine where they're going to look to find the answers to those questions. For example, let's start with the question of who. When a lender gets a loan request, one of the first things they want to know is, who is the borrower? And one of the first places that lender is going to go in order to answer that question is the business owner's business plan. So it's important that when you're completing a business plan, that you do it with the reader, and in this case, the lender in mind. This means that when describing who the borrower is or who the guarantor is, this should be more than just superficial information. The lender wants the full story as it relates to the business origins and how it got from there to where it is now. Another place that the lender is going to go to find out who the borrower is the borrower's website. A robust website leaves a good impression on the lender, and rightly or wrongly serves as sort of a proxy of how professional that company is if the business has not yet visited the actual location. The lender can also answer this question by looking at the financial statements, because the financial statements will tell the lender if the business is relatively large or if it's a relatively small company, or if the guarantor has personal financial wherewithal, or if they lack personal liquidity. Lastly, I just want to point out that the bank will also use third-party reports to answer this question to learn more about the borrower and who the guarantor is. For example, the credit report is going to tell the lender if the guarantor handles his or her personal financial, the financial information well. Also, there are companies like LexisNexis or Check Systems that will tell a banker if there's any bankruptcies or criminal records associated with the business, or if the guarantor owes any money to other banks. Other who questions that the banker is going to want to address include: who does the company sell to, and who do they buy from, and who are their competitors? Another question prompt is what. An important what question is: what is the loan request? What will the funds be used for? What is the collateral? Again, the business plan is going to provide some of the answers, but then this is where supporting information about the requested transaction becomes relevant. For example, if there's going to be a purchase of assets like a building, equipment, or vehicle, incidentally, as we discussed before, this is going to serve as collateral for the loan, then it's not just enough to write in the business plan the cost and description of these items. Yes, it's good to include the information in your business plan, but you need to also provide the supporting documentation associated with that transaction, like an invoice or a purchase agreement. In addition to providing specificity to the transaction, it shows that you're serious and the request is not just a pie in the sky. Now, while I'm on the topic of collateral again, the other important thing that borrowers sometimes misunderstand is that a bank typically doesn't lend 100% of the cost of the asset that you're looking to purchase. While that proportion varies based upon the bank and the asset being purchased, clients should be prepared to come up with 20 to 30% of the cost of the asset as their equity in the purchase. Now, separately, a major what question is: what are the risks? Now, this is a continuous question that the lender is going to ask herself as she examines every aspect of the loan package, and it is prudent for the client to know what the risks of that business are and how those risks are mitigated. Now, this isn't like filing an SEC filing where you need to specifically write every risk and every mitigant, but you do need to be conscious of the perceived risk of your business and at least be prepared to answer how you will address them. Just to give an example, suppose around this time last year, you were looking to start a restaurant. Well, other than the usual risks that go into starting a restaurant, there was this new risk of a potential government shutdown of your restaurant if it only had indoor dining. So, as in this example, it would be prudent for you to have understood that this is a perceived risk and be able to articulate how you would mitigate that risk, say by demonstrating that there was ample space for you to provide outdoor dining. Other questions include when questions. For instance, when are the funds needed? A banker is going to want to know if the business is in a crunch or if they provided sufficient time to allow the transaction to take place. Often, business owners tend to have an unrealistic time frame when it comes to closing on bank loans, particularly when it involves real estate. As I mentioned before, banks vary and some have quicker turnaround times than others, but at minimum, borrowers looking to get a bank loan should think about getting funds at least a month out from when they submit their completed loan package, but typically it's even longer, say 2 or 3 months, like I said, especially when real estate is involved. When it comes to the question of when will the loan be repaid, this considers whether this is a short-term loan request, like a year or so, or if it's a long-term loan request. Weird questions consider questions like, where is the borrower located? Or where are their customers located? Some banks only lend to businesses within their footprint. Your cousin may have received a great loan and a great rate from their local community bank in Buffalo, New York, but you may not have that same access to a loan if your headquarters is here in New Jersey. The lender is going to pull up the location on Google Maps to see that the business actually exists. The regulators have placed a huge emphasis on the need for banks to know who their borrowers are, so there's more due diligence required in making sure that the bank knows everything about the borrower, including what their operations look like. Why questions include, why does the borrower need the money? There needs to be specificity to loan requests. If you're looking to refinance existing debt, for example, you're going to have to provide recent statements to show the current balances or provide payoff statements from other banks. A common refrain is that the business owner needs a line of credit for working capital needs. While that's a legitimate need for many businesses, many banks actually decline working capital loan requests if the loan is really paying for something like a person's salary or if there's no collateral. Another why question that bankers ask is, why this bank? They want to know if the business already has a deposit relationship with them or if they're just shopping around. As I mentioned earlier, if the request is coming from a company outside of the bank's footprint, they may not lend to that company. Finally, we come to the how questions, like, how is the company doing financially? And the most important question of all to me is, how will the loan be repaid? The answer to these questions will primarily come from the analysis of the business financial statements. In other words, the business tax returns or other reporting financial statements. When a bank lends money, that loan becomes a bank's asset, and the bank relies on the interest from that asset as revenue. On top of that, there are a host of regulatory requirements that banks have to adhere to prove that they're making sound decisions when making loans and that the borrowers demonstrate the ability to repay the loan. So this question of how will the loan be repaid is an area that I see many business owners struggle with. So we're going to spend a little time here unpacking this question. It's very beneficial for you as a borrower to know how a bank determines the client's ability to repay the loan so that you're not going in blind when requesting a loan. The banker's analysis of how the loan will be repaid first starts with this question of, how is the company doing financially? A banker wants to see that the business revenues for the last 3 years have been increasing. A favorable situation is to have 3 years of increasing revenues. They're going to key in on your profit margins. If you're selling a product, the banker is going to want to see that your gross profit margin is either consistent or increasing. This lets the banker know that you have control of your product costs. The reality is that even if your revenues decline slightly, but your gross profit margin increases, that looks more favorable to a banker because it shows that you are increasing efficiency in your business. The ultimate profit margin of importance is your net profit. Again, a banker is looking for increasing profits here. They're going to look at your operating expenses and how they impact your bottom line. They want to know what your largest expenses are and how you control them so that your company remains profitable. Now, these are income statement items that we'll key in on, which ultimately impact some balance sheet items that the bank looks at when determining how the company is doing, such as leverage, which is a function of your debt relative to equity, and liquidity, which is the level of cash or assets that can easily be converted to cash compared to your short-term debt. Now, these balance sheet items are also important, but right now we're going to focus on the income statement items like revenue and profitability growth that factor more into the company's ability to repay a loan, because these income statement attributes impact whether or not the business demonstrates this, if it has sufficient cash flow to service the debt. So this brings us to a key ratio that you should be familiar with, called the debt service coverage ratio. The debt service coverage ratio serves as a proxy to answer if there is sufficient cash flow and to what degree. So there are two components to this ratio. So first, let's start with the first part. The first part is EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. So this ties into your net profit, which we discussed a minute ago. But we're going to add back a few items to this number to get EBITDA. The first item is amortization and depreciation expense. Now we're going to add back depreciation and amortization because these are actually non-cash expenses that the government allows you to deduct when determining your net income. So the benefit to you is that they assist in giving you a lower tax base, but the banker adds it back because it's not real cash going out. And in lending, we're concerned about actual cash that you have on hand to repay your loans. The next item that we're going to add back is interest expense, because this refers to interest that you've already paid on loans that you already have, and we're going to include this in calculating your EBITDA, your debt service coverage later on. So, lastly, we're going to add back income tax. And this is because this is a function of your bottom line after all your other expenses, including the interest expense, and it's not before. So now we've covered EBITDA, which we can now talk about the second part of the debt service coverage in this equation, and that's your debt service. This is essentially your debt payments. So this is going to be determined by the type and amount of the loans that you request. So in this case, we have a 5-year, $25,000 term loan that is based on a 4% interest rate. And the monthly payments are $553, which means that the annual payments are $6,630. So now we have the two components. We can now calculate the debt service coverage ratio. That is the historical cash flow, in other words, the historical EBITDA, divided by the payments on all of your debt. Now here in this example, we come up with a debt service coverage ratio of 1.62 in 2018, leading up to a debt service coverage ratio of 2.1 in 2020. Now, different banks have different requirements for the minimum debt service that they require, but typically if you have a debt service coverage of 1.25, that is typically good. Now, let's take a moment to consider what the banker is looking at here. So even though you're looking to get a loan now, at this point in time, for payments that you're going to make in the future, some later period of time, the banker is actually looking to see what you earned in the past to see if you have sufficient cash flow to cover the payment. So even when you provide projections, in most cases, the banker is not giving too much weight on your projections because no one provides projections that don't work. The banker is going to give more weight to see if your past cash flow was sufficient to cover this current debt that you're looking to get now. So this is why the process for obtaining a bank loan begins before you actually need the loan. By this, I mean it begins in your planning stages as you're considering where you want to be with your company in the next 2, 3, or 5 years. I also want to point out here that, lower revenues and, some companies report lower revenues and add additional spent expenses than necessary in an attempt to manage the bottom line and reduce their tax liability. Well, these businesses often run into problems when they are seeking a loan from a bank as they try to convince the banker that they should qualify for a larger loan than what the banker is recommending. Unfortunately for them, the banker has to rely on what is actually reported. So in a nutshell, that's what really goes on behind the scenes in a typical bank when an underwriter is reviewing a loan request. So a prepared business loan applicant is one who is prepared with the required documentation, which we discussed, one who knows what type of questions the banker is trying to answer and has sufficiently provided the information within the documentation or is armed with good answers, and one who has demonstrated historical cash flow to cover the proposed debt and has adequate collateral. Now, the good news is while banks are conservative and many borrowers, particularly startups, may find that they fall short in some of these areas, whether it be the time in business, available collateral, or having less than a 1.25 debt service coverage ratio, there are a host of other resources that borrowers can resort to if they don't meet all the requirements of a typical bank. This is where SBA loans come in handy, which incidentally could still come from a bank. And also microloans from community development financial institutions are another good place to look. So with that, I hope I was able to provide you with a good sense of the banker's perspective when examining a loan request. And if we have time, I'll answer any questions that you may have.
Thank you, Hassan. That was great. That was a lot of information in a short period of time, but it was really, really good, important information. We have, you can type your questions in the Q&A, but we have one good question from Zimbra. How do you build business credit to get the loan?
Yeah, that's a great question. So one of the things that you can do is first you have to formally establish a business. And then you reach out to, this is a company called Dun & Bradstreet. And what Dun & Bradstreet does is they formulate a profile for your business. And so once you can reach out to Dun & Bradstreet and establish that profile with the company. And then next you want to reach out to certain companies that actually report the trade business of your business. So for instance, you can open up like a Home Depot or a Lowe's card, and then you borrow on that card and then pay it back. And those companies actually report to Dun & Bradstreet. So what it'll show is your history of paying your debt back on a monthly basis. There are also certain gas charge cards that you can get, but it's important that you get it in your business name and not in your personal name, because you want the Dun & Bradstreet profile to show that your business is actually paying these trade costs back. It's a great question.
Good. So is it just any credit card would do, or?
No, not every credit card reports back to Dun & Bradstreet. So that therefore you have to research, those companies. There's another, if you actually, want to purchase office equipment for your business, there's a company called Uline, and they report back to Dun & Bradstreet. So if you're going to buy from Uline or even Office Depot, I believe Office Depot and Staples reports back to Dun & Bradstreet. But you just want to make sure with whatever vendor you're purchasing from that they actually report back to Dun & Bradstreet, because that's what's going to build your business credit history. And then it allows you to later on get, enhanced borrowing capability because it shows a repayment history.
How do I know that? Is there some place in the credit application that tells?
So, I would just reach out to the vendor, and you can actually just Google, to find which vendors report to Dun & Bradstreet, and that'll give you a list of vendors that you can do business with.
How does that apply to, like, if I went to my bank, my local bank, and I've established my business bank account at my local community bank, whatever. Mm-hmm. So I have that. Is it a good idea then to get a credit card from that bank as well? And do you think, does that count toward, do they report to Dun & Bradstreet? Right.
So again, so even when you're talking with your banker, so your banker, so your business is going to apply for the loan. And generally what bankers want is a guarantor. So they're going to want you to personally guarantee, because as you discuss with your lawyer, they're probably going to suggest that you form your business in the form of an LLC, which is a limited liability corporation, which separates you from the business and the liabilities of the business. However, banks want you to be personally liable. So in addition to your business, they're going to ask you to sign a personal guarantee for whatever loan that you're researching. but the key is that you want to make sure as you're talking with your banker that the reporting is based on your business and not your personal financials, because that's the key in terms of when what your question is, building your business credit, is that you want all of the reporting to be based on the business financials and the business reporting. And it's okay that you have the guarantee, but essentially all the decisions you want to be made based upon the business. And so, so getting back to whether or not it really matters if you have a good business credit, that's only if the bank is looking at a business credit score. Some banks don't look at business credit scores; they go basically solely on the financial performance of the business, and kind of ignore the reporting from Dun and Bradstreet. So that's part of the conversation that you want to have with your banker.
Do we have any other questions from anybody? Everybody's got this, right? How do you get a loan if your company is less than a year old? Good question.
That's a great question. So that's the challenge of many companies. So it's hard to get a traditional bank loan if your company is less than a year old, because as we talked about in the webinar, the banks tend to look at the historical financial performance of your company. However, that's why the SBA is a good resource, and in particular, a microloan from an SBA organization such as a community development financial institution, because they are there just for that, to assist startups. The other option is to use credit card debt to kind of like get you started if you actually need financing. But credit card debt is high interest, and you just want to make sure that you get out of that, as quickly as you can, because, a traditional bank loan, banks are more conservative, but the interest rates are generally lower than what you can get at other institutions.
Okay, good. And then the other thing that I wanted to come back to was that all the way through your presentation, you were talking about the importance of a business plan.
Yes.
So I would suggest that if you do not have a business plan and you need some help with that, reach out to SCORE, because our mentors are very well versed in helping people develop a business plan. And whether you're looking to apply for a loan today or not, your business may be growing, and in 3 years or whatever you need to continue to grow and expand that business, you should be ready to apply for a loan at pretty much at any time. And a business plan will help you do that.
Absolutely.
Here's another good question. If I'm starting out with a low credit score, how can you get a loan?
Yeah, so that is a challenge, because bankers are looking at you as an individual as well to see how you handle your personal finances, because that's indicative of kind of how you're going to handle the business finances as well. So I just recommend that individuals work on your personal credit and address any issues, particularly if there's incorrect information on your credit report that you want to address that's bringing your score down. But with that said, again, I refer right back to those community development financial institutions and microloans, because those are available for individuals who don't fit all of the criteria of a traditional bank loan. And there are other resources online, some institutions that are kind of geared towards helping people with bad credit. But the problem with those is they come with high interest rate. So you have to be leery about that. But, the most important thing that I recommend is addressing those issues that are on your credit report, because a banker, even if you have experiences where you were past due, or if you had charge-offs, I personally recommend that you go back to those institutions to make them whole, because that's going to, one, improve your credit score. And then that's also part of your story that you're going to share with your banker to give them a comfort level that you are a responsible person taking care of your debts. So even if, you have past issues, if you're in a position to go back and address those and make them whole, I think that's positive things that something positive that you can do to help, benefit your business loan request.
Good point. So sometimes it's better to kind of step back a little bit, get your house in order.
Yeah, absolutely.
Take a little bit of time to get your house in order. There are a lot of resources online that talk about how to build your credit.
Yep.
I know the Experian and the other companies that do the credit reportings do have a lot of information on their websites about how to analyze your credit score and how to repair your credit score. So it'd be worthwhile to take a look at that and spend a little time going back and repairing things.
Yeah,
good point. Right. Anybody else? Anybody else have any questions? It's a lot to absorb. We'll send an email to everyone that participated today. We'll include Hassan's slides with that so that you can refer to them as you build your business plan, and contact us for a business mentor. We would love to work with you. Reach out to Hassan if you have questions. Anything else?
No, that's it. Again, like you said, that's what SCORE mentors are for, to help, address needs, and, we're here to help you. So as Jane mentioned, just reach out to SCORE to help with any business issues that you may have.
Okay. Thank you very much, Hassan. This is very good. It's always good for me also to refresh my information. It was very helpful for me, I'm sure for our clients as well. Yeah, so pleasure. Thank you very much. We'll look forward to seeing everybody on our next webinar in June.
Okay.
Bye-bye.
Thanks, Jane.